So guys, we dividend investors can't resist a good deal. And with the drop we've been seeing these last few weeks, right now there are so many different discounts to take advantage of. But in today's video, we'll be honing in on 3 stocks that seem like particularly great pickups for your portfolio as we make our way into the new year. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks do you currently have your eye on. I'd be curious to hear what you think is looking good. Now guys, this first stock on our list, which is Vici Properties, is one that we've talked about before in this video series. We covered it back in July, which is right around when I started my position in this company. And now after a pretty poor month of performance, Vici Properties is back on my radar, and I think it's looking like a really good buy as we head into 2025. Now, as a quick refresher, in case you're not familiar with this company, Vici is one of the world's largest experiential real estate investment trusts. They own a portfolio of iconic properties in top gaming, hospitality, entertainment, and leisure destinations, most notably in Las Vegas. In fact, their portfolio of properties here in Las Vegas is like a greatest hits of the Las Vegas Strip. We're talking about Caesar's Palace, the Venetian, the Mirage, which is soon to become the Hard Rock, MGM Grand, Park MGM, Mandalay Bay, New York, Excalibur, and Luxor, all of which are one-of-a-kind properties in a city that I think is unlike any other on Earth. Now take a look at Vici's share price performance over here on Snapstock, which you can get access to when you become a member of the investment club. And if you want to learn more about that, there's a link to it in the description of the video. But anyway, back over here, guys, in the last 30 days, Vici Properties is down 11.2%, a very big drop in a very short amount of time. And this is going to leave the current share price back under $30 per share, which I love to see. And if we zoom out over the year to date, looking at the performance in 2024, Vici is down about 4.9, almost 5%, which on one hand is not great, especially when you consider the S&P is up close to 30% in the same time period. But for dividend investors like you and me, this kind of pullback is precisely what we want to see, especially when you consider that this drop in share price really doesn't have a lot to do with Vici in particular. The pullback was more so a result of macroeconomic factors, specifically interest rates. While rates have started to come down, the Federal Reserve recently announced plans for fewer rate cuts than anticipated in 2025. That news put downward pressure on REITs like Vici Properties, as well as other ones, as higher rates make it more expensive for real estate investment trusts to borrow money, which they do a lot of, to buy more properties and grow the business. Still, we dividend investors can rejoice in these moments because lower share prices help our investment dollars go farther, and we're able to lock in higher dividend yields when the share prices go down. And this is certainly the case for us right now with Vici Properties. As we can see looking at the dividend stats, the 5-year average yield is coming in at about 4.6%. And right now at current prices, the dividend yield is sitting at 5.8%. So that is way higher than the average. And historically, Vici's been a really solid dividend grower. We can see that since they came onto the market, they've grown their dividend every single year at a pretty substantial rate, 8.3%, which is very nice. And when you pair that with the already high dividend yield, we're looking at double trouble here in the dividend department. So with all of that said, I think Vici's looking like a really good buy right now, and I just started adding to it again in my own portfolio, and will continue to do so as the weeks go on, just as long as the share price stays kind of right around where it's currently at. I like Vici under $30 per share, so as long as that's the case for this stock, I will be adding to it. Now guys, moving on to stock number 2, it's been a while since I've talked about Old Dominion here on the channel. I'd say it's been at least a few months, but I really like this company. It's kind of under the radar, but I definitely think it's worth your attention, especially with the recent drop in share price it's seen. Before we take a look at the share price performance, in case you're not familiar with this company, Old Dominion is one of the country's leading trucking companies, and they specialize in what's referred to as less than truckload, or LTL operations, which typically pick up multiple shipments from multiple customers on a single truck, which we can see depicted in the image here. But from there, the LTL freight is then routed through a network of service centers where the freight may be transferred to other trucks with similar destinations. And in total, Old Dominion has over 260 service centers across every state in the continental US, 90% of which they own. So it kind of has an interesting real estate aspect to it as well. But at any rate, this LTL structure seems to be working very well for Old Dominion, seeing as the company has been a very aggressive grower over the years. Taking a closer closer look at that, just checking out all of the major growth metrics here back over on Snapstock, the revenue, earnings per share, and free cash flow per share. As we can see, all of these are straight up and to the right over the last decade at pretty aggressive rates as well. Starting here with the revenue growth over the last 5 years, this has grown by an average rate of 9.3%. Not too shabby. If we look at the earnings per share, this is more than double that. The earnings per share in the same time period has grown about 22% on average every year, and the free cash flow per share growth is also looking really good at about 15.4% on average over the last 5 years. And all of this growth bodes well for the dividend, which we'll take a look at here pretty soon. But before we get to that, scrolling down just a little bit more, taking a look at this company's debt situation. In addition to being a growth monster, Old Dominion also looks to have a very clean balance sheet with negative net debt right here, which essentially just means that the company has more cash on the balance sheet than they do debt, which is awesome. That's really great. And that's one of my favorite things to see. Now, finally getting to the share price performance, as we can see here, Old Dominion has definitely taken a turn for the worse. In the last 30 days, the stock is down almost 20%. And in this time period has gone from being about $225, $226 per share all the way down to about $182 per share. So a huge drop. And if we zoom out looking at the year-to-date performance, this is officially going to put Old Dominion in the red. They are down 5% here to close out 2024. But like we talked about with Vici Properties, this is a great thing to see for those of us who are regularly buying stocks every single week and every single month. Not only can our investment dollars go and buy us more shares at these lower prices, but that dividend yield just gets pushed up, and Old Dominion, truth be told, needs all the help that it can get in that department. Taking a look at the dividend stats, as we can see, the starting dividend yield with this company is really nothing to write home about. At current prices, it's only 0.44%, which is not the highest, but is still above the 5-year average of 0.34%. So there is that, and that's the silver lining, I guess, if there was one. But along with that, although the yield is low, Old Dominion certainly makes up for that in the dividend growth department. They are a dividend growth monster. Look at this, guys. Over the last 5 years, Old Dominion has grown the dividend by average 37%. Not only that, but the dividend growth as the years go on just looks to be picking up with time. In 2018, it was 29.76%. 2019, it was a little bit higher than the previous year. 2020, rough year, same thing, 32.7%. The dividend growth rate increased even more in 2021 here at 33.2%. Really took off in 2022, almost a 50% increase. And although 2023 was lower than 2022, still, if we look at the trend here, it is up and to the right. And the dividend is very well covered too. If we scroll down looking at these payout ratios, in the trailing 12 months, the earnings payout ratio is only 18%, so definitely nothing to be concerned about there. And the free cash flow payout ratio really isn't too much higher at about 23%. And overall, with dividend stats like that, although the starting yield isn't that high, with that dividend growth rate, you'll be able to really establish a killer yield on cost over time. So if you are someone who has a longer investment time horizon and you don't need that income today, maybe you're investing for 15, 20, 25 years down the road, then something like Old Dominion with that lower starting yield but killer dividend growth rate, I think is one worth considering. Now guys, stock number 3, which is Johnson & Johnson, I consider to be a beacon of stability in my portfolio. While not the fastest growing company, it sure is consistent and dependable. And for that, I think it plays an important role in my portfolio as one of the more reliable and defensive positions. And with the share price down, 6.7% in the last 30 days, and the current share price sitting in the mid 140s, I think right now is a great time to start adding to this position, or even start a new position if you don't already own it and are looking for another steady, stalwart, sleep well at night stock to add to your portfolio. But anyway, that's what went down with Johnson & Johnson this last month. And if we zoom out looking at the year to date, we can see that it's telling a pretty similar story, still down, 6.9%. So a lot of the losses so far this year have come just in the last 30 days. But either way, J&J is in the red here in 2024. And just like the last two companies with this drop in share price, the yield right now is higher than it's been in a long time. Right now, you can lock in a 3.23% yield with Johnson & Johnson, which is quite a bit above the 5-year average yield of 2.66%. And with that, lowish 3% yield, you're still able to get a near 6% dividend growth rate. So I think these are very well-balanced dividend stats. Not to mention Johnson & Johnson is a dividend king with over 60 consecutive years of dividend growth. So like I said, Johnson & Johnson is a beacon of stability, and I definitely think it's worth considering for your portfolio. And I think the same is true for all 3 of the companies that we've looked at today. But with that, those 3 are not the only ones. There are still quite a handful of other stocks out there that I think you need need to keep your eye on. The first of which, guys, is American Tower Corporation, AMT, who's seen a crazy drop in the last 30 days. This stock is down 12%. And if we zoom out looking at the year-to-date performance, it's down just a little bit more than that here in 2024, down about 12.5%. So either way, AMT is one to keep your eye on. But anyway, next up, guys, stock number 2 is Comcast. And I haven't talked about this stock for a long time, but in the last month, Comcast is down almost 11%. So another very big drop for these guys. And if we zoom out looking at the year-to-date, it's down 9.66%. And then jumping over now to stock number 3, this one is Chevron. I own this one in my portfolio. In the last month, Chevron is down 12.5%. So another very big drop for this guy. If we zoom out looking at the year-to-date performance, Chevron is officially in the red, down 1.66%. So definitely keep your eye on this one. But anyway, moving on, guys, to stock number 4. I don't think I've ever talked about this company on the channel, but this one's DR Horton, ticker symbol DHI. Crazy drop for DHI in the last month, down 16.5%, which is going to put them down 3.33% year to date here in 2024. So as of this last month, they are officially in the red for the year. And then moving on to stock number 5, this one is the Hershey Company, which we've talked about quite a bit this year. I feel like it's been on the down and out for a while now. And in the last month, the Hershey Company seen another decent drop, down 3%, which is going to leave them down 8.5% here in 2024. So definitely keep your eye on this one. And then stock number 6, guys, we've got another one of the home builders on here. We have Lennar, ticker symbol LEN, who's seen the biggest drop out of, I think, all of the stocks we've looked at so far today. It's down 20.33% in the last month, which is crazy. And that's going to leave them down 3.64% here in 2024. So this is definitely one to watch. But anyway, guys, next up is Lamb Weston. I think you need to keep your eye on this one. That's ticker symbol LW, who's down 15% in the last 30 days. We're seeing some pretty big drops today, guys, but if we zoom out looking at the year-to-date performance, it's even worse for Lamb Weston. This stock just cannot catch a break, and there's been a couple crazy dips, it looks like. Back at the end of March, it really fell off a cliff, and then again, guys, towards the end of the summer, it really jumped off a cliff as well. But overall, guys, Lamb Weston is down almost 37% here in 2024, so could be a good one to keep your eye on. But anyway, guys, now moving on to stock number 8. This is a stock that I've been talking about quite a bit this year. I think I've mentioned it 4 different times just here in this video series, this deeply discounted stock video series this year. But Nike just keeps getting cheaper and cheaper. It just can't seem to catch a break. In the last month, it's down another 2.25%, which is going to leave the stock down over 25% here in 2024. So Nike's still on the down and out. I think it's one to keep your eye on. And then, my friends, we've got Realty Income. Of course, we had to talk about Realty Income. Why wouldn't we, when it's down 9.35% in the last month and headed very quickly back down to the low 50s? We could, at this rate, even see it get below $50 per share here in the near future. We'll see what happens with it, but Realty Income had a pretty poor month, no doubt about that. And if we zoom out looking at the year to date, 2024 has not been kind to this stock either. Realty Income is down 4.44% for the year. And then, guys, sticking to the REITs for just a moment, Prologis, PLD, is another one that I think you need to keep your eye on. Seen a similar drop as Realty Income in the last month, down 9.6%, but they've seen a bigger drop here in 2024. Prologis is down 16%, so I definitely think this is one to watch. And guys, now this 11th stock is my great white whale. This one is Rollins, who's down, thank goodness, almost 10% in the last 30 days. It's getting better. To me, Rollins has just been so expensive for so long. It's been, until recently, above $50 per share, as we can see here. And so I'm very happy to see this drop in share price. Now $46.75. I hope it keeps going down into the low 40s, because that's about when I would start a position in this company. And I want to do that so bad. But if we zoom out looking at the year to date, we're not out of the clear yet. I mean, Rollins is still up in 2024, up about 12%. So overall, it's had a pretty decent year. And then, guys, we also have to talk about Zoetis, who had a terrible month. Zoetis was down 7.5%, which is crazy. If we zoom out looking at the year to date performance, Zoetis overall has not had a great year. The stock is down almost 14% in 2024, and this is another growth monster, kind of like an Old Dominion. It's very similar growth metrics, very similar dividend profile. So if you're into that type of stuff, I think Zoetis is another one to keep your eye on. Now, those are all of the stocks that I think are ones to watch right now. And if you want to hear about a handful of other stocks that I'm definitely staying away from and suggest you do the same, then check out this next video right over here. In this one, you'll learn about 3 dividend stocks that many investors like to buy, but truth be told, they're terrible investments and you should avoid them at all costs. So click right over here to learn about those, and I'll see you in the next one.